Thank you for joining us. I'm Gord Long. As always, it's my pleasure to have back with me today Charles Hugh Smith, a well-followed and prolific writer on the web who is the publisher of the website of2minds.com. Welcome back, Charles, to our first talk of the new year, and I hope 2021 turns out to be a happy and profitable year for our listeners and ourselves.
Well, thank you, Gordon. It's my pleasure, and I think we're looking forward to a very dynamic and critical year. And so we're going to cover some really important topics today.
It's going to be volatile, but there's going to be a lot of money made and a lot of money lost this year. That comes with increased volatility. But anyway, we'll talk somewhat of that as we go through these slides. Charles, before we begin, as I normally do, I need to stress with our new viewers that this is not an interview. We do these videos as a way of us productively dialoguing the important trends we're identifying and simply make our discussion available to the public for those that might be interested or want to contribute comments, which we welcome, and we read them all, I can assure you of that. Today we're going to talk about inflation and deflation and share what we see regarding both going forward. As such, we hope to cover the subject areas that I'm showing here. Any comments on this agenda, Charles, before we begin?
Yeah, Gordon, I want to stress to our listeners that the conventional view is always trying to choose either or with inflation and deflation. Like, are we in an inflation or are we in deflation? And what we're trying to illuminate today is that it isn't just an either or choice. There's both deflationary forces and inflationary forces at work in the global economy. And so what we're trying to do here is step aside from that sort of false choice that the conventional view has and illuminate how these forces are interacting. And it's almost like two rivers joining, or two tidal forces, because one appears to be the dominant force for a while, and then the other one can come to the fore. And so we're going to try to explain in like four basic points, which are covered here in our agenda, to give you insight into how these dual forces are going to play out.
Yeah, the question everybody says, is it inflation or is it deflation, is a false set of questions, like the old lawyer game, yes or no, have you stopped beating your wife yet? So it's the wrong question. The question here on inflation and deflation is going to be where and by how much, because both are occurring concurrently. And but our focus changes, and we'll show that as we go. So let's just jump right in on today's discussion, Charles. I'm going to move through the charts very quickly for the sake of time, and leave the charts, though, for those who want to study them in more detail, because the detail is there if you've got the time. We're just going to try and pick key points on the chart, so I apologize for those that said, hey, I didn't get as much out of that chart as I would like. The one I'm showing now, Charles, is just to really reinforce where we're at right now. This is the biggest speculative blow-off in history that we've ever seen. And I say blow-off because it's not underpinned by basic fundamentals on the rate of growth of profitability and any kind of measures of valuations. That doesn't mean that things are about to end badly and the world's coming to an end. It does mean that this is historically unprecedented. And this chart here shows that is really to bring it home that when we have corrections, and we can expect a correction and consolidation, at this stage they could be bigger, more violent, and take a little longer, a couple years, 18 months now. But I believe personally, and our work suggests, that we still have more to come on the other side of that. Don't ever underestimate what governments and powers to be will do to hold the system up, and the rules that will change. I saw that in '86. I saw it in the dot-com bubble implosion. I saw it with the great financial crisis. For some of us older, we see it every single time. But at the end of this, I still think there's more to go. But eventually it will end, and in a difficult time with what I believe will be a fiat currency restructuring globally. And we need also, Charles, to we need to have an appreciation that inflation and deflation are acting, as we just said, concurrently, just in different areas. And what changes is fundamentally our focus, usually associated with one or other that's changing somewhere. The change is seen as waves, which both are becoming larger and more destabilizing as a result. And the global fallout of COVID will be an important driver to both of those going forward. And we need to remember we've had 40 years of falling rates, and we're near the zero bound. And real rates, I believe, and my studies suggest, have nearly bottomed or are close to bottoming. Not nominal, or real rates. Banks have to make money or they don't lend. And it isn't just whether you can return your money, but what are their rates of earnings. And the new drivers today have also changed in that China's credit impulse and their real rate of the yuan is now the most attractive in the world and is driving money flows. And it's likely that the debt supercycle is nearing an end after 40 years and that the commodity supercycle is beginning, which could be another 40 years because both of these are long-term cycles. Any comments on those overview kinds of points, Charles?
Yeah, Gordon, I think it's important to remind everyone that we are a credit-based economy, and that's globally, right? And so what happens with yields and rates and the credit impulse you described, money creation, money supply, all of these issues are really important because we're a credit-based economy. We don't just rely on spending from savings or earnings. We rely extremely heavily on borrowed money that's then spent, right? And so that's why you're going to focus on real rates because you've got to understand how credit feeds into inflation and deflation.
Yeah, don't tell me the nominal rate. Tell me what the real rate, which is a function of what they call inflation break-evens, not the CPI. Don't ever pay attention to that to measure your investments, but look at the forward break-evens against the U.S. Treasury bonds to come up with what the real rate is and what you can measure it against. But Charles, I'm showing here a slide to remind everybody that our memories fail us, and they are failing us right now. Over in the right are just three videos that I did on this subject previously, warning and of the problems we were facing before or just as COVID was happening. That because we have the fallout of COVID, don't forget for a moment the state of the economy before we went into it. Because we were at the longest expansion, that is over 10 years, one of the longest in history. And things just don't keep expanding. They have a level where they need to consolidate. But I see there are three basic hurdles that we need to really remember and not to forget. And first, we weren't, as I just said, economically healthy, and we're living, in my opinion, on a sugar high from massive tax and regulatory cuts. From the Trump administration going into it, into COVID. And you can see here the list of some of the other issues from QE 1, 2, and 3. All it did was bring demand forward. And by bringing it forward, there's a big demand hole. We didn't fill it up with COVID. COVID's going to make the hole bigger. We got over 20% of all global corporations, and now even higher, are zombies. And we've been living on falling rates since 1980, 40 years. We're at zero or getting close. I know it's bounced recently. That's unsustainable. And you can read the rest of them. Things don't keep going. And that was the state that we had pre-COVID. Now we've got COVID. So secondly, what's the COVID fallout going to be? And let's be frank, it is yet to be felt. We're going to see, we'll talk more about it, but bankruptcy rates, downsizing waves that I see coming, cost cutting is absolutely has to happen, tax shortfalls, issues with disposable income. Each of these are long discussions. And then thirdly, we're going to see major shifts in the U.S. economy as a direct result of the recent changes in the U.S. administration of the post-U.S. presidential election. And these are, I don't, they're just not getting the press they should. But I know that it's being felt because of what's going on in the bond market. The bond market is revolting to what they're seeing happening, and that is after less than 36 days, this new administration, and this is not political. I'm just basic facts. Have brought out 57 executive orders that are being enacted, which the bond market is just completely reacting accordingly. And no, there's been no press of any degree on these 57. And for example, right now we're energy independent. The new policies change that. We've stopped the Keystone pipeline. We've stopped all new drilling and natural gas on any government lands. These are just some of them. They have profound impacts. Reversed and expanded immigration, which is going to impact lower labor rates, dramatically expanded fiscal stimulus, so it's going to be rate pressures. It's been a complete and total reversal of all of the massive regulatory reductions that the Trump administration put in. You may not agree with some of them, but they did have a profound impact in a lot of the achievements that happened that are being taken away, every one of them, which says there's going to be fallout, and we need to appreciate that going forward. Any comments on any of that, Charles?
Yeah, Gordon, I think you touched on a lot of different drivers, and I just want to kind of clarify what happens when a company or a household goes bankrupt and defaults on loans, and I just want to mention that part of what happens in deflation is in inflation, money is created when money is loaned. And a lot of people don't understand this, that, the money supply increases when a bank issues a loan, say, for a new pickup truck, right? That money comes into existence. Then when the owner of the pickup defaults, right, and the truck that has a $40,000 loan is repossessed and it's only worth $10,000, that $30,000 disappears from the money supply. It goes to money heaven. And so that's deflationary. And so you can say, well, isn't the Fed printing trillions? But what you're talking about here is on the other side of the balance sheet, when loans default and bankruptcies occur, all that money that was owed, that actually vanishes from the system. So you can create $1 trillion, but you can lose $1 trillion too.
And more, because a lot of it's then been leveraged up.
Right. And I just want to mention that deflation, we're not going to cover it in our slides because we're taking a higher level. But I just want to mention that deflation is actually a positive thing. That if you take a look, say, at the auto industry in the early 20th century, the price of a car used to be, multiple years of wages, right? It was like a luxury item. And then because of mass production, the price of a car dropped enormously. And that was deflationary, but it was positive because then it was affordable. And so what we have now in terms of like these the pre-COVID problems that you describe, we should talk briefly just about wage stagnation. That the wages, the earnings were no longer buying. They didn't have the buying power that they had in previous decades. In other words, you're buying fewer goods and services, even though you might be making more money nominally. And so that's where when we look at like inflation and deflation, you can say, oh, well, I'm making more money than I did 10 years ago. But if your money is buying less, then that's inflationary, and you're actually losing ground. And so that's where it's also tricky to say, well, which one is it, inflation or deflation? It's all like, well, wage earners have suffered inflation, right? But there are deflationary forces, at the higher level that you're describing here.
We can never forget that in our system, in the developed world, money is only created by being lent into existence. It's not so much that it's just printed, but it doesn't really become money until it's lent out. And then there's a fig that goes with it. But as you clearly point out, it works in reverse, and it works faster in reverse. It takes a long time to lend out money. Defaults happen instantaneously. And bankruptcies, downsizing, right sizing because of slowing consumption is a death bell for the growth of money. Ever mind the velocity of money, which impacts inflation. So that's the understanding we need to keep in mind. This graphic I'm showing now, Charles, is a roadmap that I believe we've been experiencing over the last 40 years. I put this out here last year to try and reflect in red inflation and in blue deflation and how they occur. But each of these have been getting bigger and larger. And as you can see at the bottom, for various reasons that have been the big focals and the big drivers. But so, as deflation has become bigger waves on top of a more fragile and brittle global system. And so we're at the point where some of this is going to break existing institutions, loans, and corporations that are highly over-leveraged. They're just almost too big a percentage kinds of shift, and you can see here in the deflation side. I think this chart shows my opinion, where we are right now, and we're going to be seeing inflation here over the next as a focal point, as the media hype with it, and we're seeing in the bond market with inflation. But we're rounding out, and the big story in about 6 months, maybe sooner, is going to be everything we've been talking about with deflation, and that is the fallout of those three hurdles that we had talked about earlier. This chart I put together, Charles, in a presentation last year about the 2021 would be about commodities, which has turned out it would be a big year for gold and silver, but you had to be really careful because this 2021 reflation was going to bridge into the red, and I had it mapped out over the next 2 years, 22 through 24, of massive deflation, which would take even gold back, and then eventually, then that would turn for other reasons you listed here at the bottom, and then we would accelerate out. The point I'm making now, and the reason I kept it to show it here today, is that's all changed. Everything on there, maybe not the idea, but it's been brought forward. That's what this note, it's been really brought forward because of the magnitude of the shift in the U.S. monetary, fiscal, and public policies. I can't understate how significant it is and how little focus people are talking. It's like business as usual. This is not business as usual. The shift in policy in the United States is something we've never seen this dramatic, and it's getting no visibility. Charles, what I did try to do is put together on one graphic what's impacting inflation and what's changing behind it in the drivers, because there's multiple waves that are overlapping at different frequencies with different focuses. So the top, I'm showing the S&P 500. Below it is inflation, deflation, a second one. The third one is money supply, and then the last one is yields and lending. But they're hard to see. So I'm going to start with this first one I'm showing here on the right, and that's actually the second one: inflation and deflation. And we'll step through all four in a sequence. And we're presently, in my mind, catching up on inflation expectations. Markets lead by 6 to 8 months, and we expect that after that, as we've said, we'll fall into a deflationary downward trajectory. We haven't addressed any of the COVID fallouts, as we mentioned, and we basically just kept them temporarily afloat or papered over. The governments have no real strategy, no plans in any country of how they're going to handle it and how they're going to finance it, because we're going to see massive small businesses, but in the order of hundreds of thousands have already failed, aren't coming back, or are coming back with huge financial problems. We've got COVID sectors such as travel and leisure and hospitality that will never be the same. I didn't say that it's coming to an end there. It's just it's going to have to be reinvented, and it's overstructured. We have commercial real estate, the forbearances that are not being paid right now, whether for rental properties, for residential properties, or commercial real estate. Never mind, some of them are now really going to. a Zoom economy and are kind of cut back on their real estate. Real estate's a big driver here in America. We got 20% of these zombie corporations and the worth reverse wealth effect. That's all here. Any comments on that, Charles? I have up here a slide on deflation and inflation. Just some more further points.
Yeah, I think I'm really pleased with your presentation here. That the graphic of the wave. In other words, and I think what I would want to stress here is the conventional financial media has been stressing the idea that inflation is going to soar, and we're just apparently on the edge of hyperinflation, and so everybody's been front running this like huge surge in inflation by buying everything that they think will go up, as inflation really starts taking off. But what you're showing here is this initial wave of inflation. It's a little too early to say we're on the cusp of hyperinflation, because there has to be a deflationary pop of all this bad debt, uncollectible debt, and collateral that's no longer worth what it was when the loans were made. And this is where you mentioned commercial real estate. It's a good example. A building may have been worth $10 million a few years ago when rents were sky high, and that was justified. Well, now the building is either half empty or 90% empty. It's only worth a fraction of what the loan value is. And so, as we're saying, when that building goes into default, $9 million will vanish from the money supply. And the banks will take a huge loss, and that's not something they can replace with a new loan to some other commercial building, because the entire sector's been damaged, right? And I think we can also mention here that the middle class, as we've discussed, Gordon, in many programs over the last decade, the middle class used to rely on earnings and savings and investment. And the middle class today relies on debt. There are huge numbers of families that have outstanding debt on mortgages, student loans, credit cards, autos loans. And as those households get under pressure and start, declaring insolvency, all that money is going to vanish, and that's enormously deflationary.
Precisely, Charles. And then on the other side, as these are failing, the government policies, what are they going to be? And the only thing I know what governments will do is print more money or create more credit or push it out. But it's not how are they going to do it? And don't underestimate how they'll do it. But that will lead. It's what happened in the Weimar Republic and it's a consistent pattern. And then you get hyperinflation because of just not printing more money, but the policies that go with that, which is a final blowout. And I studied them years ago. There are 52 events of hyperinflation occurred in the world. And what really shocked me is they only last about 6 to 8 weeks. The longest was 6 months. They're actually very short-lived, but they're a final complete Minsky melt-up where asset prices and everything suddenly shoot up, but there's no foundation because it's all based on funny money before there has to be a reset. Often it's been a collapse. I'm not saying it's a collapse here. It'll be a formal or new changing of institutions, a new Bretton Woods, a new reserve currency. We'll come up with solutions, but it will be a massive reset. Charles, this chart here showing shifting focus as we go from inflation to deflation. This wave going down, or first disinflation, is the bottom. Where we're going to go from pre-COVID, where we had financial assets were inflating. I think we're going to see this reverse wealth effect. We did a whole show on and explained here. Sometime this time last year. And on the other hand, foreign goods have always been a deflator. Our inflation has been in services. The deflation, example, electronics and everything else has been holding the same or going down, which has really been deflationary in terms of our economy, which has been really good. I see that changing because of what we're seeing with one, purchasing power, the dollar changes, but the incomes around the world for us to have consumption bankruptcies and advent of robotics that's coming. But we're seeing it in the supply chains, the disruptions that are happening right now, because it's all built on what they call a jet or Kanban system. I know I used to be in the supply management business, and it's just in time. And so everything works where the product, you don't hold inventory. It arrives just at the point where you need it in the manufacturing process. You do your assembly or whatever the structure is you're in the supply chain, and then pass it on. And so you don't want to be holding that. The problem is when you stop it and suddenly you have a shortage, even if it's one component. I know right now chips in the car are really hurting the global automotive industry because they can't get certain chips. It isn't all the hundreds and hundreds of components. It's one or two, and you don't have a product that can be finished. That's what's happening right now. You can't get shipping because there's just too much catch-up that's trying to happen. And out of this, there's going to be companies that will fail that were on the border, marginally on the border, that can't get going. They suddenly they have cash flow problems, and they can't get kind of bail out of their creditor tightening, and that'll lead to driving up prices. They're not going to give it away. They've been giving it away and fighting on price for years now, but the margins are so thin right now. They got no choice. They have to increase prices. So suddenly, I believe that goods will be an inflationary item going forward. And had been deflationary before. So this is the shift that nobody's really paying attention to. Comments on that, Charles?
Yeah, I think it's your slide touches on a number of points. I just want to emphasize that the global economy as a whole over the last, say, 30 years from when, and especially the last 20, from when China entered the WTO, the economy's been optimized for two major conditions. One is falling rates. In other words, it's always cheaper to borrow money next year, right? And you can always buy a new car at a lower rate or refi your mortgage. And that now has changed, right? The falling rate cycle, as you described, is ending. And so that is the economy's optimized for falling rates. Rising rates, it cannot deal with it because it means it's going to cost you more money to borrow than less. And then the other thing is globalization, which is these long supply chains. And we've talked about it in many programs where there, again, when you want to optimize your supply chain, you end up having one or two suppliers because they're the ones who provide the cheapest price and so on and so forth. So you get rid of redundancies and duplicate supply chains. Well, so when there's a problem with one or two suppliers or one or two shippers or one or two manufacturers, then you get this cascading problem through the supply chain. And so, and as you mentioned, in terms of policy changes, there's a lot of nations around the world that are realizing that their reliance on these foreign suppliers is actually a national security issue. And that's certainly an issue here in the U.S. And so I just want to mention a lot of people believe that inflation or deflation is only a monetary issue, right? Like if the money supply is increasing, then you get inflation, and if it's declining, then you get deflation. No, inflation can arise from shortages, scarcities that have nothing to do with the money supply. And that's what you're describing here. And so and that as globalization downshifts and decays and diminishes, we're going to see more of this kind of inflation or caused by scarcities and shortages.
Let me put some butter on that, Charles, in terms of scarcity. That we have chased financial returns to such an extent that nobody will tolerate returns that are not outstanding, that are out 5 and 10 and 15 years. And what that brought itself into is the investment in new mines and new basic resources have been cut to the bone. We just went through a whole issue with silver supply and gold supply. There's just not enough silver, as an example, being mined to support the demand. And so because the costs have been artificially, and it's not unique to those two precious metals. It's right, whether we're talking iron ore, copper, zinc, nickel, any of the EV electric volt kind of supplies. I'm seeing it consistently because we haven't invested. And you can throw money at it, but you don't create a new mine in 6 months. It takes 10 years. It'll take you 3 years to just get the regulatory approvals. These are long process. So when you jam on it, some kind, even if demand is falling in Creighton, now the world is still growing. There's a real bottleneck that we've built into it because of our chase for short-term demands. That's not a speculation. That's a fact. Anybody that's at the beginnings of the supply chain will tell you that's been their biggest problem. Because what we've done, and it goes back to what we were just talking about a little earlier, Charles. We went from a world of capitalism where capitalism is about people saving money and that savings going into productive investments that actually generate returns on that savings and increase our standard of living. We don't do that anymore. In actual fact, we do not have capitalism in the truest sense. What we have today is creditism. So instead of savings, we create credit. And instead of it going into productive assets, it goes into consumption. Consumption does not return anything other than maybe some short-term happiness. It doesn't pay for itself. Once it's consumed, it doesn't go back and replenish anything. So when you have a 70% consumption economy in the United States, you're right on a hairy edge if anything disrupts that consumption because you haven't invested. I would pick on China right now. They got all these empty buildings and that they build ghost cities, but at least they have assets that could generate wealth at some point. We don't. It's all consumed, and that's the shift when you get to a creditism system, and we're there. And we've yet to ever even begin to face the pipe run. World's not coming to an end. These are just major readjustments, and with them come phenomenal investment opportunities, Charles, if you can just understand them. And that's to understand these charts here. This is the money supply. If you look at any chart for 2 years right now, on the S&P equity, they track the global liquidity proxy. I've shown them. I've lost track to our subscribers. And it's like tick by tick by tick. How long are we going to keep increasing the rate of the global liquidity? At some point it stalls out, and it is, because more money doesn't mean more lending, as you're pointing out, and it also doesn't mean that more stimulus actually generates more growth. We've reached the point where it's actually hurting the economies. More stimulus was very powerful for years. A dollar worth of stimulus got $8 worth of economy. Now you're lucky if you get 40 cents or even less, and many argue it's now zero. So pumping more liquidity is going to reach a peak. And what we're going to happen is it's going to decelerate. I didn't say stop, just the rate of, it's the first derivative. It's the rate when it starts to change and slow. The money, everything starts to change. And as you can see, I personally see that sometime at the end of this year, beginning of next year, if you follow the chart line on the left, and then it starts to fall off. And once it falls off, and starts to even shrink, that has profound implications all the way around. And if you look at the 10-year yield, for those that have been following the bond market, which is, we've never seen the volatility like we've seen in the last 3 or 4 weeks in literally decades in the bond market, where we've seen yields were at 0.6 on the 10-year shoot through 1.61 here last week. Just this rate, it's not just the absolute amount, it's the rate of the speed that it's increased. And somewhere around 1.75, there's a lot of different discussions on how that is measured. It's going to impact the equity market. It's going to be better to be invested in bonds than it is on the yield you'll get out of equity markets. It's my opinion, Charles, I've done a lot of work, that in actual fact the 10-year real rate follows the 12-month forward of the world's technology stocks. And so the 10-year plus 2%, which gives you 3.5, is the break even if the global yield for the global technology stocks doesn't achieve it. And we're just at that point right now. We're right at that cusp. And that's how dramatic the importance of this level. And at 1.75, we're there. And we could have a massive consolidation. In what I think it'll be is a shift from growth to value to the bond market short term, and into value stocks, which are found in commodities right now. And I've talked about that. But the sequence we're going to go through is inflation. The Fed will react to that, and that's what YCC, that's yield curve control, and they will drive down the yields. But we'll still see rising real rates. And nobody's going to lend if you're getting negative real rates. We had the issue with negative bonds in Europe, but that was an abnormality, not longer term and broad based. And so I will then move where the problem is going to be not inflation or yield control, it's going to be currency. And then we'll start to see really weakening currencies, which will drive up inflation, and it'll push the yields up. I'm saying 2.5% here before we start to see some topping process out later into next year. We don't know what that is. I just know these charts are changing, but we're watching them very, very closely because, again, markets look out at least 8 months, so you better be on the right side of going forward on that. This is the S&P chart, and so I think we're close. Right now we could see a fall off, this impact of rising rates, and through the end of Q3, just an opinion, and our charts our technical analysis is showing that, but we have a rally, and as we go into Q4, and then as we get into 2020, this falling liquidity, rising insolvencies starts to take the market down, and that's how these are. And there's more that drivers, but I just wanted to make it simple. Comments on any of those, Charles?
Yeah, well, Gordon, I just want to mention that you're showing how all of these interact with each other, and I think that one of the key things in a credit-based economy, as you say, creditism, is lenders, banks and mortgage companies cannot lend if they can't make money, and so we're at the turn of this 40-year cycle of it's always cheaper to borrow it next year, right? The declining real rates. As that has now shifted and rates are rising, then it makes it much more difficult for lenders to make money, especially loaning money to people who are already over indebted or corporations that are over indebted, because now every debtor, when they roll over or borrow more money, they're going to be paying more money in interest than they were in the past. And so this is going to create a crunch that few people understand, that after 40 years of declining rates, now that rates are starting to click up for whatever reason, then it's going to, the lenders are now in crunch time, because it's like, I don't care how much money the Fed prints and gives to the banks. If the banks can't find credit-worthy borrowers because everybody's over indebted and their profits and their wages are declining, then they can't lend money. So it's like dead money, right? And so you can print $1 trillion and it can sit there doing nothing because the lenders can't find anybody who can they can loan to and make a profit on. And so that's where this it's critical that we look at the real yields and understand that if you can't lend money at a profit, then you're not going to lend money.
The banks currently have over $2 trillion of excess reserves at the Federal Reserve. Excess reserves. That's money they can lend out at 10 times. That tells you all you need to know. And it was because the Fed was paying a better rate than they were willing to take with risk lending it out. But that should never be. That's a sign of the worry that's already in the system. And you mentioned, the lenders to corporations, individuals can't pay their bills and they won't lend them. What about governments on this? They're in the same boat. They can't. It's just not a matter of printing the money. It's got to be lent out. But they're going to be forced, and as this chart suggests, taxes. We're going to see inflation in the form of federal and state taxes, sales taxes, local. I believe local property taxes have yet to be seen. Licenses, fees, tolls, surcharges are all going up. There's going to be impairment costs passed on for COVID. I could see many places with COVID taxes, special taxes that are coming. So don't underestimate. Those are contributors to this different area of inflation. I see no way out. You don't see governments laying off massive amount of people. They just raise the taxes because we all want the services. Where are they going to do it? That's yet to come. So this chart here, I'm showing stagflation. Charles, is really something that I see us going into, something comparable to what we saw in the 70s, which I grew up in, and business-wise. And when we'll see modern monetary theory, we're already seeing it, helicopter money, all sorts and more, creative ways, guarantees, more conservatorships, ways of bailing out or taking over corporations to stop them from going completely into bankruptcy. And what it means is this chart here with the big G, is it means just more government spending. That's I think I read the other day 33% of all Americans now are living on some form of government subsidy or program. I mean, we become a dependent economy. This leads to things like guaranteed disposable income, or guaranteed income rather, the kinds of programs if the jobs aren't there. And so this chart is trying to say is money is changing to create consumption, to create investments, and we're not necessarily the same amount of trade in the net trade. And the bottom line of this chart here is showing is trying to show how important real rates are. And you got the U.S. Treasury, and you take away from it what the break even is on inflation, and you can see we recently were at negative 1% on that break even, which is real problematic. I think it was probably likely too low because now we're seeing treasuries at 1.5 in the second column. Break evens are now risen to about 2, but the real rate is actually up a little higher. And I think the trigger, as I said, 1.75. I'm showing 1.8 here on the right. Maybe the break evens go to 0.25. Now we've got a problem. Now we're contracting on that real rate. I don't think that's going to be allowed. It's going to have to increase. So we're going to see commodity pressures on that break even as we sort through. But these are the numbers you have to be watching to really understand why things are happening and when they're going to happen. And I'm showing here this financial conditions index. This is what the Fed's watching. The Federal Reserve has got all sorts of tricks. They want to take some of the euphoria out of the market. It's just way above what they want, but they don't want to kill the lending, etc. But right now, lending conditions are tightening, and it's the rate at which they're tightening. And I don't know how much further they will allow it, but they're going to start to get quite concerned. And also the money to finance. We lend a lot of money or borrow a lot of money from foreign investors besides what we just arbitrarily create ourselves. But this time last year we had the highest real rate in the world, and China had the lowest. Today, China's bond is 3.28 on the 10 years. Ours is only, as this morning, 1.47, and yet their real rates, which were the lowest last year, are now the highest. So money is now moving in massive way. The carry trade is now moving to China, and China wants that because it's looking to expand the presence of the yuan around the world. It's been beautifully played in my estimation. And if you track any of the movements, and I've done all sorts of videos and papers that we track with about 12-month lead time, the Chinese credit impulse. And one of the things that's driving our rates up right now is, in fact, the credit impulse from 12 months ago in China that spiked up. And that's what's going to take it up. No, all this talk in the newspaper is just ridiculous. That's what's driving it. And I've got charts right here that really show that. This is showing on the bottom right the 12-month lead time, and that Chinese credit on the 30-year real spiking. I can show it in multiple factions or factors. It's been pretty consistent going back ever since the 2008 financial crisis. That's when the financial powers to be fundamentally shifted globally for what that's worth. Comments on that, Charles?
Only real quickly that I love this chart that you post here because it shows that we live in a globally dynamic situation. In other words, it's not just what happens within the U.S. or the Federal Reserve policy. We're in a shifting global environment that's going to have tremendous impacts on the U.S. economy in terms of stagflation. So it's not like we can just kind of close the door and think that the U.S. economy is somehow protected from what's happening outside. Because, of course, we know 60 to 65% of all U.S. corporate profits come from overseas sales. And so this is just one example of how the world economy is going to impact the U.S. economy.
I am fully with you on that, Charles. I'd actually be stronger. The world now is taking its lead and is being driven by China. And that's just not an overstatement. That is what's driving it. Its yield, its credit increase, its import exports, its buying of commodities. We all know it's significant. It's now the controller. And the financial markets are taking the lead from it. This is comparable to the shift we saw between Britain and the United States. Yes, the United States is still the reserve currency in terms of the dollar. Yes, it still uses a 10-year bond as the parent risk-free measure. But that is shifting. And that is shifting because we're moving from a unipolar world to a multipolar world. And this is the era of the Asian world is now there. And so you have to look at their measures to really understand America. It used to be the other way around. Now, I would say it's pretty close. You got to be looking at both. But the charts that we're looking at, things that we're reacting to, are more and more Chinese-driven financial measurements. The problem is you can't trust any of their financial numbers. But then I'll leave that for another day. Charles, in conclusion, some of the points I meant last year, or earlier rather, at the beginning of this presentation. Real U.S. Treasury rates, I think, are bottoming. 40 years of falling U.S. rates, I think, are ending. The debt supercycle is ending, and the commodity supercycle is beginnings. And the distortions now have just become too great. Zero-bound policies, 15 trillion in nominal negative yielding global debt, just insurmountable. Mortgage rates versus real estate affordability, we mentioned, et cetera. Yields are going up, but first by inflation and then by currency. But it doesn't mean the world's coming to an end. There's going to be some adjustments. And this last chart I've showed many times, and this is the process that you have a fiat currency failure. Everything started when we got off sound money and vis-a-vis went to fiat currency. It wasn't backed by anything other than the faith in the government. And that's misfounded. That's why it used to have to be bought, denominated in gold. And it's not so much gold, it has to be denominated in something that somebody just can't create out of fictional. But this is a cycle we usually go through. We're now in the fiscal policy stage where we're really going to abuse that with just out and out printing of money. This $1.9 trillion stimulus plan for COVID in the United States, and it should have been out in September, isn't going to COVID relief if you read it. It's going to bail out a lot of states that did bad planning and pension plans, etc. So we're at that stage. Next up is going to be a loss of confidence. And a confidence for a lot of the things we just talked about. And lost confidence, what it means is people stop investing. They stop speculating. They hope they hunker down. And that's a wave we yet to see, and that'll come out of these waves that we've shown over the next 2 years. And then it leads to another problem where we get bigger failures, and then we start the system over again. We reset, but it ends with going back to sound money and money that we can trust in. Any concluding comments, Charles? We moved along pretty quickly here, but I hope we hit the highlights of the things that everybody should look at.
Yeah, no, I think that this the slide you have on the cycle that we're going through is really important. And my concluding comment is, if we look at history, and I'll just mention the 1600s, which was a century of climate change, the mini ice age, and there was a lot of conflict and disruption. What we saw was exactly what you described. Governments at that time borrowed way too much money. They tried to debauch their currency, create currency out of thin air. And then they raised taxes, sometimes tripling or quadrupling the taxes to the point where people literally had no money to eat if they paid the taxes that the government was trying to collect. And so what we're talking about here is the response of authorities and elites and governments to crises, and they actually do the same thing again and again and again through history, and all their responses only make the distortions and problems bigger until the whole thing collapses. And so, my blog post today is, when will this travesty of a mockery of a sham finally implode? And that's basically what we're talking about. It's you jack the distortions up. You haven't solved the problems. You're only making them worse. And so this is where your chart here really explains it. Everybody's going to lose confidence in these policies that are only making the problems worse, and then that leads to a total reset.
My experience has been, Charles, that it always takes longer than I think. And I think the videos that you and I have done over the last decade, we've always been, I don't know, 2 or 3 years before things that we talked about really hit, maybe sometimes shorter, but we've been ahead of the curve. Typically, we've been right, we have, but it's just that we've been early, and that's a lesson you learn, is just how long things can go on. So this can go on for enough time for people to lose a lot of money and make a lot of money, but also it goes slowly, but then all of a sudden it goes very fast. Somebody said, "How did you go bankrupt?" They said, "Slow at first, then all of a sudden." And that's what happens. And it's like why hyperinflation is only 6 months or 6 weeks, because then it suddenly explodes. But you never know when that final spike is coming. But it will happen unless we make some really profound global changes. This is not just a U.S. problem. This is a global problem that needs a reset in the most constructive manner to operate better, because we never really planned a global economy. It just took over and happened, and that doesn't mean that it was done correctly or doesn't need repair. Charles, can you tell our listeners how they could follow a lot of your writing and your reading? Because I know you're putting out a fair bit of materials.
Please visit me at of2minds.com, and all the archives are free, and you can read samples of my latest books.
I apologize for both of us that we took this long. This is probably getting close to an hour, but we didn't want to break it up into multiple sessions, and did it at once, and I'm not sure what we could have taken out, but I hope you find it enjoyable, and we really look forward to any comments or suggestions that you might have. So, Charles, we'll talk again next month sometime.
Thank you very much, Gordon.
Talk to you. Bye.